In the realm of personal finance, there are three tips that I consider absolutely indispensable. These aren't just basic financial tips, but instead, they form the very foundation of a stable financial existence. They are the pillars that hold the house of financial stability and prosperity. Understanding and applying these tips can be the defining line between financial success and failure. The first of these tips is setting achievable financial goals. It's important to delve deeper into the why and how of this. Setting financial goals is not just a task to tick off your to-do list, but a serious commitment to your financial well-being. It is a compass that will steer your financial decisions in the right direction and a roadmap that will lead you to your intended financial destination. Does it mean for these financial goals to be achievable? It means they should be realistic, something that you can actually attain given your income, spending habits, and other financial factors. If your goal is to save $1 million within a year on a moderate salary, it may be far from achievable. Instead, you may want to start with a smaller, more realistic goal. Perhaps saving a certain of your income each month or reducing unnecessary costs to increase your savings. Whether it's saving, investing, or paying off debts, having clear goals will shape your actions and decisions. Saving requires discipline and consistency. Investing requires knowledge and risk assessment. Paying off debts requires determination and sacrifice. Each of these is an important financial goal in itself, and having a clear plan on how to achieve them can make the path smoother and less daunting. Moreover, setting financial goals is not a one-time task. It requires regular review and adjustment depending on the changing circumstances of your life. If you get a pay raise, how will it affect your savings goal? If you incur an unexpected expense, how will it affect your debt repayment plan? Being flexible and adaptable with your financial goals is a crucial part of this journey. Finally, the motivation needed to achieve these goals is fueled by the desire for a secure and comfortable financial future. With the right mindset and the right goals, you can make strides towards financial freedom. The importance of this first tip cannot be overstated. It is the first step towards financial success and a prosperous future. The second key tip is prioritizing financial education. This means dedicating a portion of your time and energy to understanding the landscape of personal finance. It's about more than just knowing how to balance your bank account. It's about understanding every single facet that makes up your financial well-being. Take a moment to think about your budget. How much do you really know about its structure? How often do you review your income and expenses? It's not enough to merely create a budget. You must also comprehend how to make it effective, how to adjust it as your financial situation changes. Mastering this can help you control your spending, save for the future, and plan for unexpected expenses. Now shift your focus towards the world of investments. It's a complex field full of jargon and nuance, but a crucial one to comprehend. There are diverse investment options available to you: stocks, bonds, mutual funds, real estate, to name a few. Each of these carries its own risk and reward profile. Understanding these options and how they fit into your financial goals is a key part of financial education. Then there is the matter of risks and insurance, savings account types and their interest rates, retirement planning, and tax strategies. All these elements play a critical role in your financial health. Remember, knowledge is power, and this holds exceptionally true in the realm of personal finance. Arming yourself with this knowledge can pave the way for better financial decisions, leading to increased wealth and financial stability. And in the grand scheme of things, this is what really matters. It's not just about making money, it's about making your money work for you. In the financial world, education makes a difference. It's the difference between living paycheck to paycheck and building a strong, secure financial future. It's the difference between feeling overwhelmed by financial decisions and confidently navigating your way through them. It's the difference between being a passive observer of your financial life and taking active control to shape it in the way you desire. The power of financial education cannot be overstated. It truly is a key to financial success. And we can't overlook the third tip: building an emergency fund. This principle is not only a cornerstone for our financial health, but also a pivotal key to maintaining our peace of mind in times of financial instability. It acts as a buoy in the stormy sea of unpredictable expenses that life often throws at us. Now, what exactly does an emergency fund entail? It's a stash of money set aside, separate from your main savings or checking account, specifically for unexpected costs. It provides a net of financial security that can catch us when we stumble upon unexpected hardships. This could be anything from sudden medical bills, car repairs, home maintenance, or even a sudden job loss. In essence, an emergency fund is a financial buffer, a life jacket that keeps us afloat when the waters of life get choppy. Let's take a closer look at why it's so important. Say, for instance, you lose your job without warning. With an emergency fund in place, this unfortunate event won't sink you into debt or cause insurmountable financial stress. Instead, you'll have the financial resources to weather the storm until you find a new source of income. However, how much should you save? Most financial experts suggest that your emergency fund should be equivalent to 3 to 6 months of your average monthly expenses. It's a substantial amount, yes, but think about it like this. It's enough to cover your basic needs like rent, groceries, utilities, and other regular bills while you sort out your financial crisis. Building an emergency fund is indeed a marathon, not a sprint. It does require discipline and consistent effort. It would help if you started small, and as your earning power grows, so does your emergency fund. Remember, the aim is not to hoard wealth, but to create a safety net that protects you from financial pitfalls. So, how do you go about building this safety net? Begin by setting a monthly savings goal. Allocate a certain percentage of your income towards your emergency fund every month. This disciplined approach will not only ensure that you're consistently contributing towards your financial safety, but will also inculcate a habit of saving. Having a financial cushion equivalent to 3 to 6 months of expenses will provide you with security and allow you to face unforeseen situations without jeopardizing your financial stability. So there you have it. Set goals, invest in your financial knowledge, and build an emergency fund. These are just the basics, but they form the crux of any successful financial plan. Now let's delve a little deeper into each one. Setting goals may seem like an obvious step, but you'd be surprised at how many people skip this crucial part. When we talk about setting goals, we are not merely talking about deciding that you want to buy a house or a car. It means setting specific, measurable, achievable, relevant, and time-bound goals. It's not enough to say that you want to be rich. Determine how much money you want to have and by when. This will give your financial journey direction and purpose. The second is investing in your financial knowledge. The world of finance is vast and complex, and it can be quite intimidating for beginners, but don't let that scare you. The internet is filled with resources that can help you understand the basics. Read books, listen to podcasts, watch videos, or take a course. The more you know, the better decisions you can make. And as you continue to learn, don't forget that knowledge is useless without action. Apply what you have learned and watch your wealth grow. Last but not least is building an emergency fund. Life is unpredictable and emergencies can happen at any time. This is why having a financial buffer is so important. An emergency is not just about having money set aside for unexpected expenses. It's about peace of mind. It's knowing that even if you lost your job tomorrow, you'd still be able to pay your bills for a while. It's knowing that if your car broke down or if a medical emergency arose, you wouldn't have to go into debt to deal with it. So guys, these 3 pillars, setting goals, investing in your financial knowledge, and building an emergency fund, form the foundation of a strong financial future. They require time, effort, and discipline, but the payoff is more than worth it. They are not just one-time tasks, but lifelong commitments. Remember, wealth building is not a sprint. And with these 3 pillars, you can confidently run this marathon. If you find these tips helpful, don't forget to like and subscribe for more financial content. See you in the next video.